How many companies sell an addictive product, make billions of dollars in profits each year, have a founder running the company, coming back to the company to run it again, make sure it, does well in the years ahead, and you have a stock price that's absolutely in the gutter, dropping significantly in the last few weeks. Today, we are talking about Starbucks stock, SBUX, trying to figure out if now's the time to buy. What price would I personally consider buying? We'll talk about this and more, and why the stock has recently sold off so significantly over the last few months, and is this potentially in bargain territory? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own shares in Starbucks. SBUX is the ticker. So yeah, the stock price just in the last few weeks, you're looking at about a 30% drop just for 2022 so far, where it previously peaked. And so what's going on? What's hitting the company? So first of all, it's good to have some context. In China, they have effectively a zero tolerance policy for COVID. And so you see strong lockdowns wherever COVID cases pop up. So that is affecting Starbucks' Chinese operations. And they talk about how China comparable store sales decreased 14% in the most recent quarter, driven by a 9% decline in average ticket and a 6% decline in transactions. So it's harder to transact when you're on lockdown. So this was having a big impact on their business. Another aspect that's hurting Starbucks' underlying business is the concerns that their profit margins are going to go in the gutter, going to go down significantly from here. And part of this is because you have a lot of baristas saying, hey, this has been tough the last few years, dealing with COVID. We want to either unionize, we want to get better benefits, we want higher pay. And so you not only have higher inflation, you have wage pressures as well. You have baristas saying, show me the money. And so those are, I'd argue, some of the key components, the wage pressure, inflation in China. I'd argue on the peripheries, you're also seeing increased competition. I did a prior video on Dutch Bros. BROS is the ticker. They're only about 2% the size of Starbucks' North America business, but they are quickly taking share with the younger generations, rapidly growing, 55% growth last quarter. So what they're doing is resonating, and Starbucks is reacting to it, or at least they're trying to. You could see the percentage of total cold beverages in the U.S. company-operated stores has gone up significantly over time, offering sort of some zany beverages like Dragon Drink to sort of, I think, appeal to the younger generations that would otherwise find themselves at the rapidly growing Dutch Bros coffee company. And so what's all this translate into? And this is something I've been calling out for some time now. I'm saying, look, you may not see it right away, but seeing the macro aspects, such as higher interest rates, having significantly higher inflation, you look at these data points, it's going to trickle through to these companies over time, and then it does get repriced in the stock. So you might see the stock price start getting weaker before they even announce the results, and that's fundamentally what's going on. Is people saying, wait a second, if there's higher inflation, will people have the money to, let's say, even afford to go to Starbucks? And so you start having this trade-off. So you are looking at weaker guidance. Now, a couple of different things about their guidance. They're still saying, now keep in mind, this is the previous CEO before he was booted out by the founder, Howard Schultz, and I'll talk about that in a second. But they were previously guiding to single-digit comparable store sales growth, high single digits. So that's good for the stores that are existing and have been open for a while. And revenue guidance range of $32.5 billion to $33 billion. We'll consider that when we look at our valuation framework at the end of this video. They also talk about anticipating over 200 basis points, so 2% of incremental margin pressure. Okay, so margins take a hit to the tune of 2% from inflation, COVID-related pay, new partner training, and support costs, as well as reduced sales from mobility restrictions. That's a call out to China. But they're saying, look, we got to invest in our people, and this costs money, not only because we're seeing, retention issues where people say, hey, I want to get better pay, I'm going to leave. So they're saying, okay, we're going to need to do better training, support, so that way, let's say people stay for longer. And so that's a key aspect here that's impacting their margins. Another aspect, and this is a core aspect on why the stock got hammered, I'd argue, is that their guidance was effectively saying, hey, yeah, our earnings per share is expected to decline by a range of 4 to 6%. Now, part of that's because comparing to the prior year, you had an extra week, but still no one likes to, own a stock where you're saying, hey, their earnings are declining. Is this a big problem or is this a one-off thing? And management also talks about how, look, assuming no other significant impacts, including further impacts from COVID, that's sort of the wild card, we anticipate our earnings per share to return to double-digit growth in fiscal 2023 and beyond. Now, keep in mind, this is the prior management before Howard Schultz, sort of kicked them out. Now, finally, given the dynamic operating environment and the incremental cost pressures reflected in our fiscal 2022 guidance, we now expect year-over-year margin improvement in fiscal 23 with a return to long-term target of 18 to 19%. Now, that's the long-term profit margins. Once again, these are the critical data points that you want to have in mind when you consider what's the value of this company. You think about, okay, this is the potential margin structure of the business. This is their potential growth. What does this business look like over time? Because these are the key points that you want to consider when valuing this business. And so once again, as I alluded to earlier, Howard Schultz, the founder of Starbucks, he's back to caffeinate Starbucks, the company, rejuvenate it. One of the first things he did that sort of shocked Wall Street is saying, yep, I'm going to suspend that share buyback. Now, part of this might be to appeal to sort of populistic tendencies of saying, hey, we're not going to be buying back, our shares with billions of dollars of free cash flow. We're going to instead, figure out ways to reinvest it in the employees. So it might be, tamping down that pressure to unionize for the baristas, saying, yeah, we're going to figure out ways to reinvest in our employees without having to unionize. That's probably the language that I would expect. But they're saying, hey, we're cutting the buyback, which is, could be billions and billions of dollars. They're quick to point out, look, he's been with the company for several decades previously. He grew the company. He's the founder. He grew the company from 11 stores to more than 28,000 stores in 77 markets around the world during his tenure. He delivered a 21,000% gain in the value of its stock price between its IPO in 1992 and his departure as CEO in 2017. So this is making investors wonder, wait a second, could this be the start of an further epic run in Starbucks stock? And that's why I want to, analyze what's the potential from here. So where does Starbucks stock go from here? We're going to talk about that in 1 second. First, if you're interested in finding potential multi-baggers, the types of stocks that potentially go up hundreds or even thousands of percent over time, or you'd like to follow along with my personal financial journey, go to unrivaledinvesting.com, where I write a weekly letter. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. Once again, unrivaledinvesting.com, click join the journey. So as you analyze Starbucks, you need to understand there's sort of three segments. You have North America, which is represented in the top. You have international, which is bottom, and there's also channel development, which is even smaller. So North America is nearly 3/4 of the business. And the channel development, that's about selling coffee beans and licensed ready-to-drink products. It's the smallest of the different three segments. So this is looking at their most recent quarterly results. And it's interesting to think about it. Let's think about this. So you see store count in North America is effectively flat. Not material change year over year. It's a shade under 17,000. North America is tapped out. So future growth for the vast majority of their business is effectively going to come from consumer discretionary income. This means, effectively consumers are going to say, hey, do I have a few extra bucks in my pocket to splurge? I'm going to get that coffee. Maybe I'll get that pastry too. Or maybe I'm not even going to get that coffee because of inflation this month. Oh, my gas bill was so high. Maybe I don't get it. So that's a core aspect that you want to think about with this business. Like, how much further growth do you have in North America with 17,000 stores already? That's going to be tougher. That said, they call out, look, they talk about their change in ticket. That's effectively how much is being spent. The change in comparable sales, up 18%. Change in ticket, change in transactions, 12%. So that's more people sort of going back to the stores. Now, this is off of a weak quarter last year in response to COVID. So you're looking at broadly people coming back to the stores, but also people paying more, also their ability to raise prices. And that's what makes them in a strong position. Now, you look at their international segments. International has a much longer tail for potential growth, partly because they're still investing significantly in China. What you're looking at is 9% growth in store count. So this is at 17,000. China alone is around 6,000. So if you think they can continue to invest and grow, maybe this becomes the real growth driver for them. That said, as you can see in the first quarter, $1 billion in operating profit from North America versus just $300 million from international segments. So it's a long way to go in terms of really driving their business. And North America is going to be a key driver and it's really going to depend on U.S. discretionary income. So looking at the historic valuation, you see that it's historically traded, back when it was a hyper growth stock, you were talking about 35 to 50 times forward earnings. So this was a very much loved stock back when they were growing at great clip, and you generally didn't get it at a super cheap multiple. You paid up for it. You paid up for the growth, and that makes sense, when you have a good story like this. Then Great Recession fell down to a single-digit earnings multiple. Now it's around 25 times forward earnings for what is projected by Wall Street for this next year, which I'd argue this is a key aspect that investors should consider, that broadly over time, valuation multiples generally go down for companies the longer they live, because the longer they live, this is a generalization about businesses, is that it's harder to grow. And the harder it is to grow, the lower ultimately that multiple should be, because you're not baking in what is that growth potential. Now, there is possibility of acquisitions and other things, but over time, it's tougher to get that higher multiple, let's say 35 to 55 times like it previously traded, because that growth profile is not going to be there, as much as I'd expect. You're not going to go from 17,000 to 30,000 new stores in the U.S., I don't expect. What I do expect to see is some major value-ish hedge funds announce major stakes in Starbucks if the stock price stays around here, maybe goes lower, because I would expect they see this free cash flow. They're desperate for ideas. They've been, looking for things that are compelling, and they've been, finding things at 30, 40 times earnings. So to finally see something at like 20, 25 times earnings, they're going to say to themselves, I'm probably not going to lose that much money for a good brand like Starbucks selling an addictive product. And so looking at this valuation, how do you think about this business? How do you get to the valuation? You look at it, and they generate nearly $6 billion in operating profit operating cash flows in the most recent fiscal year, around $5 billion 2 years prior. You look at 2020 and it was impacted by COVID. And so looking at what they spend that money on, about $1.5 billion getting spent on effectively new store openings, another $2 billion spent on dividends, and then periodically doing buybacks. You saw $10 billion in buybacks a few years ago. They pulled back the buyback significantly during COVID, which seems like it was a bit of a mistake, and then did nothing this past year. Now, this is around $4.5 billion in free cash flow based on what they're doing. And so this is a really good question for you to reflect on, is what do you think a $4.5 billion payment, if you could have something that's going to pay you $4.5 billion, plus potential pricing power over time, plus the growth prospects of investing internationally, and then you start thinking, what's that growth rate? $4.5 billion, what is that worth? Plus a little bit of growth. Maybe 5, 10, 15%, some growth rate somewhere around there, depending on discretionary income as well. So that's the starting point for you to start thinking about, what would I be willing to pay for that whole thing? So here's a back of the envelope valuation framework, looking around $84, the current share price as it's sold off, around $100 billion valuation. You see, nice growth in 2021, around 24%, revenue growth. This year, they talked about 32.5 to 33 billion. So that's, low to mid-teens growth. I do a full range of 10 to 15% growth for the year. They talk about long-term margins of 18, 19%. This is I'm going to say this is the after or pre-tax earnings, because they do have, some sizable interest payments, about 500 million. So this is net of that, around 16 to 18%. I feel like this is very reasonable. You might have some inflation pricing pressure that can cause their margins to go down. Maybe they have to invest even more in personnel to maybe offset any sort of union concerns. So maybe you have this lower range of terms of where the margins end up. You see a 21% tax rate. And so you see a stock that's effectively trading somewhere between 21 times and let's say 25 times in the year ahead. Based on what do you think the margins should be based on optimized margins long term? This is thinking about what's the long-term earnings multiple based on, where it's trading at now and what it could have earned theoretically in 2022. So then we look out over the next 4 years, so making this a total of a 5-year framework. What did they grow at over those years? So I'm penciling out 7% to 11%. This, once again, this is, it's important for you to think. Do you think it could be even worse? Do you think, and honestly, 7 to 11% could be great. The question is like, could it be 3%? In which case, could this valuation get really hammered because people are like, what, I just don't have the money for my Starbucks. I got to go home and save some money and make my own coffee. And so you do have that sort of questionable trade-off. And so you look at this, you see this framework, 7 to 11% growth rate, assuming an end multiple 5 years from now, somewhere between 15 and 20 times. I'm effectively saying, yeah, over time, I think the multiple could come in a little bit from here, partly because, once again, the bigger you are, the harder it is to grow, the lower that valuation multiple, arguably. And so then looking at it, potentially over the next 5 years, you effectively break even, because you need to factor in that they still are generating billions in free cash flow that should be accruing to you as a shareholder. So maybe it goes down a bit. Maybe you break even over the next 5 years. A lot depends on how they return capital to shareholders. Another aspect is that maybe it goes up around 50% from here, plus whatever capital gets returned to you. So maybe you get a low teens dividend. The way I kind of look at it is, it reminds me of this sandwich, is that there's a lot of investors that are sort of really, really hungry for compelling ideas. And it's sort of like looking at that sandwich that's a breakfast sandwich, and it's towards the end of the day, and you're like, I know that's been sitting out all day, but I'm just so hungry. I gotta do something. I'm gonna buy that breakfast sandwich. So I think that's what you see with a lot of investors considering this type of deal with Starbucks. I don't find it to be super compelling. If I'm personally not ready to pull the trigger on it. And so then you might ask, well, Daniel, what price would I consider buying it? So for this type of setup, where I'm looking at consumer potential pressure, and I'm looking at active margin pressure from inflation, and also the challenges in China, I'm looking at these different data points, and I'm saying, given this framework, and given that their growth rate could be lower than it was in the past, I think that 25 times multiple, a lot of folks are anchoring to their prior growth rates. I think you need to look at what they could be in the future. Let's be a little more conservative. At least that's my preference on my own personal journey when I consider different things. And so I'd look at this and say maybe a teens-esque valuation on an earnings multiple, because then you sort of get a little more cushion in terms of safety with valuation. Then you don't have to worry about valuation coming in as much, and then it's just about growth. It's about pricing power, raising consumer discretionary income, increasing. You see more people shopping, so that in a teens multiple, maybe around $50 a share, maybe a little more, maybe a little less. That's around the price that I would be more interested in. In all honesty, I think probably its best days are behind it in terms of the stock price's growth rate, seeing this thousands of percent upside, maybe as you saw with this valuation framework. And keep in mind, hypothetical framework, a lot depends on how management executes and the underlying sentiment. If sentiment just completely falls apart because for some reason their growth rate drops to 5%, which would be disappointing for Wall Street, you could see valuation really fall apart, and that's from 25 times earnings multiple. So you do need to consider all these aspects when you consider it. A lot depends on execution and sentiment. So of course the stock price can go way higher or lower. I look at this and I don't find it to be crazy compelling, but I do call out, what ideas that I do find to be interesting, potentially, cheap stocks that have, low growth rates, or hyper growth stocks at interesting, valuations, or potentially even cheap. So, and I do that at unrivaledinvesting.com. If you're interested, click join the journey. And if you enjoyed this video talking about Starbucks, SBUX stock, where I'm not ready to buy the stock for my own personal journey, I would want a cheaper valuation, just given that the growth rate isn't, crazy high. That's just me personally. I'd love to hear your take though. So if you're a mega bull on Starbucks stock and you're like, oh man, this is going to rally big time from here, I'd love to hear it. And also if you're a bear, if there's a point that you feel like I'd miss, I definitely want to hear it. Thanks so much for tuning in. Please leave a comment below. And if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much.